America has been here before, standing at the edge of a financial cliff, hoping that gravity waits just a little longer. But this time, the numbers are different. The warnings are louder, and for the first time in decades, even the people who usually tell us everything will be fine are beginning to look nervous. The United States has crossed $38 trillion in national debt, a number so large that even economists have stopped trying to explain it. A number that grows every second, faster than the government can count it, faster than taxpayers can pay it, and faster than the Federal Reserve can pretend it doesn't matter. For decades, Washington played the same game. Borrow, spend, push the problem forward. But 2026 is shaping into something different, not because of one crisis, but because of multiple crises stacking on top of each other like unstable dominoes. And the last domino, the one that could send everything crashing down, is the same one the world is watching right now: tariffs. Since the new tariff policies were announced, markets globally have entered a strange, uneasy silence. Investors don't panic at first. They hesitate. They wait. They hope the storm passes. And that hesitation is exactly where every big crash begins. In the last few months, global trade has slowed more sharply than many expected. Several European companies issued quiet warnings, not loud enough to make headlines, but loud enough for insiders to panic. Asian manufacturers have started cutting production. Shipping data shows declining container traffic, and American importers are scrambling to adjust supply chains that took 20 years to build. A tariff doesn't hit instantly. It works like a slow shockwave. First it hits businesses, then consumers, then banks, and finally the government itself. And the reason 2026 is so dangerous is because this shockwave is hitting a country already drowning in debt, with almost no room left to maneuver. Every debt chart in America looks the same right now. Straight up. Federal debt at historic highs, corporate debt near records, consumer debt breaking all-time highs, credit card delinquencies rising, auto loans under stress, mortgage demand at a 30-year low. Everything in the system is stretched to the limit, and when a system is stretched, it does not need a massive blow to break. A small cut will do. A small shock, a small policy change, a small tariff increase. And Washington officials assure the public that tariffs will strengthen American industry. They say it's part of a long-term plan. But behind closed doors, the Congressional Budget Office quietly updated projections, warning that interest payments on national debt would soon become the single largest expense of the federal government. Bigger than the military, bigger than Medicare, bigger than Social Security. For the first time ever, the U.S. is paying over $1 trillion a year, just in interest. And that number is based on interest rates not rising. But what happens when global investors demand higher yields because tariffs slow growth? What happens when markets lose confidence? When interest rates rise even slightly, a $38 trillion debt becomes a detonator. In the bond market, traders are bracing for volatility not seen since the pandemic. Treasury auctions are showing signs of strain, indirect bidders pulling back, foreign buyers hesitant, and primary dealers forced to take more supply than usual. These are the early signs, the same early signs that appeared before previous financial stress events. But this time, the economy is loaded with far more explosives. In manufacturing states, small businesses are reporting a new kind of uncertainty. Not the uncertainty of demand, but the uncertainty of price. What used to cost $100 to import yesterday may cost $125 next month, or $140 next quarter, and no business can plan production with that kind of instability. So they slow down, they delay orders, they cut workers, and unemployment creeps upward. Not fast enough to trigger alarms, but fast enough to weaken the system. In the housing market, the effect is subtler. Tariffs increase the price of construction materials. Higher prices reduce new building activity. Slower construction pushes rents up, and higher rents strain the already over-leveraged consumer even further. America's middle class has never been more exposed to rising costs, and tariffs spread through the economy like hidden inflation, touching every industry silently. Meanwhile, global partners are already preparing countermeasures. Several nations have hinted at reciprocal tariffs. Some have signaled a shift towards strengthening trade within Asia and Europe, and others are considering reducing U.S. Treasury purchases over concerns that rising tariffs will slow American growth and weaken long-term stability. For decades, the world supported U.S. debt because the American economy was viewed as the safest. But what happens when that safety comes into question? China and India have already increased strategic commodity stockpiles, anticipating supply disruptions. The European Union is reviewing internal energy and industrial policies to reduce dependency on American trade flows. Japan is strengthening agreements with South Korea and Southeast Asian partners. Globally, everyone is repositioning, but inside America, the consumer is already breaking. Household savings rates are near record lows. Credit card debt is at record highs. Delinquencies are rising fastest among young adults, a sign of deeper systemic stress. And for the first time in over a decade, major retailers have begun quietly preparing for a demand slowdown. Not because people don't want to spend, but because they can't. Everything becomes dangerous when a system is fragile. A tariff may seem like a political decision, but economically it acts like a tightening noose. It forces prices up, it slows trade, it pressures businesses, it reduces investment. And when businesses cut investment, the job market weakens. When jobs weaken, tax revenues fall. When revenues fall, the deficit deepens. And when the deficit deepens, the government must borrow even more. And all of this happens while interest payments explode. Imagine owing $38 trillion and the cost of borrowing suddenly jumps. That's the nightmare Washington is facing. A nightmare the public still doesn't fully understand. In 2025, America spent more money on interest than it did on national defense. In 2026, many economists expect interest payments to surpass the cost of healthcare programs. This has never happened in U.S. history, not even during war, not even during recession. It means the government is losing control of its own budget. It means a crisis doesn't need to start with banks or housing or tech. It can start with the government itself. And that's the part most Americans are not prepared for when the government becomes the epicenter of the crisis. In the final months of 2025, Wall Street analysts began publishing cautious notes using terms like systemic risk, fiscal instability, and policy shock impact. These terms don't appear often. When they do, they foreshadow trouble. The bond market is often the first to see a crisis, and right now, the bond market sees something coming. Some insiders have begun comparing the current moment to 2018, when tariffs previously rattled global markets. But the difference today is obvious. America did not have $38 trillion in debt back then. Interest rates were near zero. Inflation was stable. Supply chains were intact. Today, everything is different. Inflation is still sticky. Rates are high. Supply chains are fragile. Consumers are stretched thin. Corporations are over-leveraged. And the government has less fiscal space than at any point in modern history. A tariff shock in this environment is like dropping a match in a dry forest. The earliest warnings will not come from the stock market. They will come from credit markets, widening spreads, rising default risk indicators, and tightening liquidity. Then commodities will react, then currencies. And somewhere down the line, when the pressure becomes too visible to hide, the stock market will follow. That's the sequence experts fear. And that's the sequence 2026 seems to be entering. The world is watching America's debt problem, not because of its size, but because of its speed. The U.S. is adding debt faster than at any time outside of a national emergency. But right now, there is no war, no pandemic, no crisis that justifies this explosion. It's happening in peacetime, quietly, invisibly, without public debate, and the financial system is noticing. Meanwhile, the Federal Reserve is trapped. If the economy slows because of tariffs, the Fed will face pressure to cut rates. But cutting rates while inflation is still above target risks a repeat of the 1970s. Keeping rates high will crush the bond market and explode interest costs. The Fed has no easy path, no painless decision, no soft landing ahead. Every option leads to pain, just different kinds of pain. This is why 2026 is not just another economic slowdown. It's the convergence of three forces: crushing debt, aggressive tariffs, and declining global confidence. And once these forces reinforce each other, the outcome becomes predictable. Crises do not begin with panic. They begin with pressure. Pressure builds quietly, slowly, invisibly, until it doesn't. And that pressure is building now. Pressure always builds quietly until one day it becomes impossible to ignore. And in early 2026, that pressure begins showing up in the places most people never look. Freight data, treasury auctions, lender surveys, corporate bond spreads, numbers that don't make headlines but decide the future long before the public notices anything wrong. The first real cracks appear in global shipping lanes. A sudden slowdown in container demand forces carriers to cut routes. Export-dependent nations feel the hit immediately. Factories in Southeast Asia scale back production. Ports in Europe report lighter traffic. These aren't just economic signals. These are warnings that the global machine is grinding slower, gear by gear, month by month. Tariffs act like friction. Everything becomes more expensive to move, to build, to sell. And when prices rise while demand weakens, corporate margins get crushed. That's why American companies start revising their earnings guidance at the beginning of 2026. Quietly, carefully. They don't want to trigger panic, so they blame global conditions or uncertainty in trade policy. But investors know what those phrases mean. They're code for, we're not confident, we see danger coming, we're preparing for it. Meanwhile, a less visible crisis begins behind the scenes. Inventory buildup. Retailers, wholesalers, manufacturers, everyone has too much stock. Goods ordered months earlier under old pricing models are now stuck in warehouses because consumers can't absorb higher prices. The excess inventory forces companies to slash future orders. And when orders fall, factories slow down even more. A slowdown that started abroad begins coming home. American consumers are already at their breaking point. Wage growth has cooled. Inflation hasn't returned to normal. Rent is eating more income than ever. Credit card balances are setting new highs every quarter. For the first time in decades, even high-income households are cutting discretionary spending. Restaurant traffic is down. Retail footfall is falling. Online sales are slowing. And when the most resilient consumers begin to pull back, the economy enters dangerous territory. But the real alarm doesn't come from consumers. It comes from banks. Regional banks begin reporting rising loan losses. Not catastrophic, but trending upward consistently. Small business loans are hitting delinquency rates not seen since the last recession. Auto loan defaults are accelerating. Credit card charge-offs are climbing fastest among young borrowers and low-income families. Banks start tightening lending standards. They approve fewer loans, increase requirements, reduce risk-taking. And when banks pull back, the entire economic engine loses momentum. At the same time, the U.S. government faces its own dilemma. Tariffs were supposed to bring in revenue. Instead, they contribute to inflation, depress consumer spending, and shrink economic activity, all of which reduce tax revenue. Budget deficits widen faster than expected. Monthly Treasury reports begin projecting significantly higher borrowing needs. Washington prepares to issue more bonds. But global investors are already hesitating. Several foreign central banks quietly reduce their purchases of long-term treasuries. They don't announce it publicly, but the data tells the story. This withdrawal forces the U.S. to offer higher yields to attract buyers. Higher yields mean higher interest costs. And higher interest costs make the debt spiral even worse. This is the moment when the bond market becomes the central character in the story. Most Americans don't realize that the bond market, not the stock market, controls the fate of the economy. When confidence in government borrowing weakens, the entire system begins to shake. Investors start demanding more yield to compensate for risk. Every additional percentage point adds hundreds of billions in costs over time. And once rates move in that direction, reversing them becomes almost impossible without aggressive intervention. A few financial institutions start warning clients about liquidity shocks. Some hedge funds quietly reposition out of long-term bonds. Others increase bets against government debt. This isn't a panic, it's preparation. The sophisticated money always moves first, months before the public sees the headlines. By mid-2026, the economic mood shifts in a way that feels subtle but unmistakable. Companies freeze hiring. Venture capital funds slow investments. Startups feel suffocated. Large corporations announce strategic restructuring to cut costs. Layoffs, initially hidden in local reports, begin appearing nationwide. Job losses accumulate slowly but steadily, tens of thousands at first, then more. A weakening job market hits consumer confidence. People stop spending. When they stop spending, businesses lose revenue. When businesses lose revenue, more layoffs follow, and that feedback loop is how recessions form. But this isn't just a recession forming, this is something deeper, something systemic. Because while all this is happening, the tariff situation escalates. Trading partners respond with their own tariffs. Europe raises duties on American agricultural goods. Asia targets U.S. manufacturing. Several countries begin reconsidering dollar-denominated trade settlements. These moves don't destroy the U.S. economy instantly, but they weaken it strategically. And in a world already drifting toward fragmentation, the timing could not be worse. The supply chain, once global and efficient, becomes fractured and politicized. The costs of production rise. Delivery delays increase. Markets become unpredictable. And businesses, forced to choose between higher costs and lower profits, start raising prices again. Inflation rises, not drastically, but enough to trap the Federal Reserve once more. The Fed wanted to cut rates to prevent a recession, but tariffs and supply disruptions keep inflation elevated. So instead of cutting, they wait. They hesitate. They signal caution. And the markets interpret that hesitation as fear. When the central bank shows fear, investors panic. At first, the panic appears in emerging markets. Their currencies weaken sharply. Foreign investors pull money out to seek safety in the U.S. But ironically, that safety is no longer guaranteed. Commodity prices spike unpredictably. Gold surges to new highs. Bitcoin rallies as investors seek alternatives to traditional finance. But these asset moves aren't signs of confidence. They're signs of doubt. Investors run to anything that looks safer than government debt. Inside major investment banks, internal risk alerts flash yellow. Some trading desks begin operating with reduced leverage. Risk officers push for conservative strategies. Banks increase collateral requirements for certain types of trades. In the financial world, these are the tremors before the earthquake. Then the credit markets tighten further. Companies with lower credit ratings struggle to raise funds. Junk bond yields spike. Corporate refinancing becomes dangerous. Several companies face liquidity problems. A few warn publicly, many stay silent. Analysts begin tracking which corporations won't survive if conditions worsen. Meanwhile, Ordinary Americans feel the shift only in small ways: higher grocery prices, shrinking paychecks, more layoffs, higher interest rates on loans. But beneath those small changes, an enormous structural shift is taking place, one that will become visible soon. By the end of 2026 first quarter, something unprecedented happens. Multiple Treasury auctions underperform in a row. Foreign demand is weak, domestic institutions demand higher yields. Primary dealers are forced to absorb excess supply. Financial media begins debating whether this is a sign of a deeper issue, and the public, still unaware of the danger, hears only fragments of the story. A government with $38 trillion in debt cannot afford rising yields, but yields are rising anyway. This is the point when policymakers realize they may have triggered something they can no longer control. Tariffs were meant to be a strategic weapon, but they have become a financial accelerant. They worsened inflation. They slowed global trade. They weakened growth. And now they are squeezing the bond market, the single point of failure that can ignite a crisis larger than any recession. Markets begin pricing in a severe economic downturn. Analysts start using language that hasn't been used since 2008. Terms like credit freeze, debt rollover crisis, and stagflationary recession appear in financial reports. Economists warn that the combination of tariffs and debt could be catastrophic, and global investors, seeing the storm building, begin moving out of U.S. assets entirely. This is how a domestic policy decision becomes a global event. The dollar weakens sharply against major currencies. Safe haven flows shift to gold, the Swiss franc, and even commodities like copper and oil. Hedge funds bet aggressively against U.S. bonds. Foreign governments reduce exposure to long-term treasuries. And at that moment, the U.S. enters the most dangerous phase of any financial cycle: the confidence decline. When confidence in a nation's debt fades, everything else begins to fail. The stock market becomes volatile and unpredictable. Retirement accounts shrink. Pension funds panic. Corporate investment collapses. Housing demand evaporates. And every part of the system reinforces the other, turning pressure into crisis. But this crisis doesn't explode instantly. It builds, moment after moment, decision after decision, mistake after mistake. And all it needs is a spark, a missed auction target, a major corporation defaulting, a foreign country announcing a shift away from the dollar, a geopolitical shock, a supply chain disruption. Anything, even something small, could trigger the chain reaction. The world is now watching the United States not as the anchor of global stability, but as the potential source of global instability. And for the first time in generations, the question is not whether America can prevent the crisis, but how far it will spread when the crisis finally hits. The storm has not broken yet. But the sky is dark, the winds are rising, and the first drops are already falling. The storm doesn't hit all at once. It begins with a moment so small that most people barely notice it. A major U.S. corporation issues an unexpected earnings warning, citing unforeseen financing pressures. The statement sounds harmless, crafted by lawyers and public relations teams. But the markets understand what it really means. A company with billions in assets can't refinance its debt. Credit has tightened so much that even the giants are struggling. Within hours, credit default swap spreads spike. Traders begin hedging aggressively. Risk models across Wall Street update themselves, flashing red for the first time in years. Firms quietly reduce leverage, funds de-risk. And in a financial system built on confidence, caution spreads faster than truth. The stock market opens sharply lower the next morning. Not a crash, just a deep, uneasy drop. Analysts try to calm viewers on television, calling it an adjustment, a healthy correction. But the numbers behind the scenes tell a very different story. There is no liquidity. Buyers are scarce. Sellers are nervous. And the people who move markets, hedge funds, family offices, institutional investors, are repositioning at a pace that signals they expect trouble. When the second warning comes, it's bigger. A major European bank announces exposure to U.S. corporate debt significantly weakened by the tariff-related slowdown. Their capital buffers are adequate, they say, but markets don't believe them. The bank's stock collapses, credit markets freeze further, and suddenly alarm bells ring across global financial centers. The U.S. government responds with reassurances. Officials insist the system is strong, the fundamentals are solid, and there's no threat of contagion. But bond yields continue rising, Treasury auctions remain weak, and the cost of insuring U.S. government debt hits a level not seen since the 2011 debt ceiling crisis. This is the moment when fear moves from the edges of the economy to the center. Americans reading the news begin to feel uneasy. Social media fills with clips of analysts debating recession probabilities. Some people withdraw cash just in case. Others move money into gold or crypto as a hedge. Bitcoin surges not because of hype, but because trust in traditional finance is fading. And every uptick in crypto reflects a downtick in confidence elsewhere. Then the spark arrives. A mid-sized regional bank, already weakened by souring commercial loans and rising defaults, announces a sudden liquidity shortfall. They attempt to raise capital. No investors step forward. Within 48 hours, deposit outflows accelerate. The FDIC steps in. It's the first major bank failure of the year. Markets don't panic, yet. But the psychological shift is unmistakable. If one bank can fall this easily, others can too, especially those exposed to real estate, consumer debt, or corporate refinancing. Fear spreads quietly at first, then suddenly. Commercial real estate, already under pressure from remote work, enters freefall. Property developers miss payments. Office buildings lose value. Lenders refuse refinancing. Debt tied to these properties is bundled across banks worldwide, and each failure becomes another crack in the system. Meanwhile, the U.S. Treasury faces its worst auction in decades. Foreign demand collapses. Domestic buyers demand higher yields. Yields spike so fast that financial algorithms trigger automated selling. Bond prices drop, and in that drop lies the core of the crisis. A government with $38 trillion in debt cannot afford rising yields, yet yields are rising anyway. The Federal Reserve steps forward with an emergency announcement. They pledge to stabilize markets. They signal readiness to adjust policy as needed. But the statement lacks clarity. Investors want action, not reassurance. The absence of an immediate rate cut sends markets deeper into turbulence. By the next week, global stock markets are falling in tandem. Europe is struggling. Asia is weakening. Emerging markets are collapsing. Commodity prices swing violently as traders attempt to price a world where everything is uncertain. The United States enters the final phase of the meltdown, the confidence crisis. Confidence is intangible until it's gone. And once it disappears, it takes years to rebuild. Americans begin withdrawing money from riskier banks. Not a panic, but enough to put stress on smaller institutions. Money moves rapidly into major banks, money market funds, treasury bills, crypto, and gold. Every shift drains liquidity from somewhere else. Every movement tightens conditions further, and every tightening step accelerates the downturn. Businesses respond to the chaos by cutting expenses. Projects are canceled. Expansions paused. Factories scaled back. Layoffs surge. Within weeks, unemployment jumps at a pace not seen since the pandemic. And when job losses hit the middle class, the crisis becomes real to everyone. Consumer spending collapses. Retailers issue emergency profit warnings. Airlines reduce flights. Hotels slash rates. Restaurants close locations. The service economy, once resilient, begins to crumble under the weight of uncertainty. And through it all, the tariff war continues. Trading partners retaliate harder. Agricultural exports plunge. Manufacturing orders shrink. Technology firms face barriers in multiple regions. Even allies begin distancing themselves from U.S. trade reliability. This isolation accelerates the downturn. The very policy meant to protect American industry is now strangling it. Within the government, internal pressure builds. Economists warn that deficits are spiraling out of control. Interest payments are projected to exceed all forms of discretionary spending combined. Emergency borrowing becomes necessary. But borrowing at high yields becomes catastrophic. The United States approaches a dangerous threshold, the point where debt, interest, inflation, and tariffs collide to create something larger than a recession, something closer to a structural realignment of the global economy. The Federal Reserve finally acts. In an emergency meeting, it announces rate cuts, liquidity injections, and expanded lending facilities to prevent bank failures. But the cuts come late. Inflation remains high enough to limit aggressive easing, and markets interpret the move as desperation rather than strength. The stock market reacts with wild swings. Some days show massive rallies driven by short-term optimism. Others see historic declines. Volatility becomes the new normal, and behind each swing is the same underlying truth. The foundation of the financial world has cracked. Internationally, the collapse spreads like a shockwave. European economies enter deep recession. Asian markets restructure supply chains to avoid U.S. exposure. Latin American currencies plummet. Middle Eastern sovereign funds shift away from U.S. bonds. The global financial order, built around American stability, begins to fracture. Inside the United States, ordinary people feel the collapse more intimately. Mortgage rates skyrocket. Home sales freeze. Car loans become unaffordable. College students face higher borrowing costs. Small businesses close at record speed. Major corporations announce mass layoffs. And the American dream, for many, feels like it is slipping out of reach. Amid the chaos, two assets rise dramatically: gold and Bitcoin. Investors seek refuge from a system they no longer trust. Crypto exchanges experience record inflows. Bitcoin becomes both a protest and a lifeline, an escape from the debt-driven system at the heart of the crisis. But even these rises reflect fear, not triumph. Every surge in alternative assets signals deeper distrust in governments, banks, and traditional institutions. By late 2026, The government is forced to introduce emergency measures not used in generations. Restrictions on certain capital flows, temporary guarantees for vulnerable banks, accelerated Treasury funding programs, political divisions intensify, public frustration rises, and global confidence in U.S. leadership reaches historic lows. The crisis does not end with a single dramatic moment. There is no bell that rings to signal the bottom. Instead, the collapse becomes a long, grinding period of adjustment where the world slowly redefines its relationship with the U.S. economy. International trade reorganizes around regional blocs. New financial alliances form. Some countries begin settling energy and commodity transactions in non-dollar currencies. The global economic map redraws itself. Inside America, recovery becomes a slow battle. Jobs return gradually. Businesses adapt. The Federal Reserve rebuilds credibility. But interest costs remain enormous. Debt remains overwhelming. And the lesson remains unmistakable. No empire, not even the U.S., is immune to the consequences of debt, conflict, and economic miscalculation. The collapse of 2026 becomes a defining chapter in financial history, a moment where the world finally understood how fragile the global economy truly is, where the decisions of a few reshape the lives of billions, and where a storm built from tariffs, debt, inflation, and declining trust revealed the weaknesses hidden beneath decades of prosperity. No one saw the exact moment it would break, but everyone felt the pressure long before it shattered. The world didn't end, but it changed. And in the aftermath, a new financial order began to rise, one built not on the illusion of endless borrowing, but on the hard lessons of a collapse that could have been prevented but wasn't.